Hi, this is Dave Morgan from Cannes, and I'm excited to be here with Terence Kawaja, the founder and CEO of Luma, the creators, founders, and propagators of the Lumascape. Terry, what brings you to Cannes?
You know, Cannes is a terrific industry event, and it's all about aggregation, right? We've got just such a concentration of senior decision makers here in one place. I remember being skeptical about coming here, but people said deals happen here, and there's a lot of people here, and you really ought to come. So last year was my first time, and let me tell you, I will return every year because it just has a unique quality that you can hardly get elsewhere. And besides, we're in the south of France. We're on a yacht.
So Terry, I'm reminded with a lot of the talk that's going on here about actually the origination of the Lumascape, because one of the things that struck me, and you and I have talked about this, was that the original Lumascape was actually one of several slides that had to do with the various concentrations or complexity of not just the display business, but search and TV. And the real point of it was, while everyone focused on the incredibly cluttered slide that was display advertising, this was in an IAB conference, you know, I'm thinking it was 6 or more years ago, there were 2 other slides there. And can you tell us a little bit about that and maybe bring us up to date about what that means with what we're now seeing as a real, you know, focus in the industry on not just display, but digital video and television?
Right. Well, you know, when I first sort of introduced the Lumascape and walked through the various players, I mean, obviously the sort of the first conclusion you draw from the snapshot of that page is that there's massive fragmentation, right? In particular in the display era, and in that presentation you're referencing, I wanted to point out that this isn't necessarily the case in all channels. So I talked about how many players there were in display for a relatively small amount of spend. I then compared that to search, where there were much fewer players with more spend. And then, of course, I made the reference the linear television, where there was hardly, you know, very, very small group of players at a massive amount of spend. I think my punchline was 3 Jewish guys from LA.
Yeah, so let's bring this up to date. So what do you see happening in the marketplace? And tell us a little bit about it. I mean, there's a lot of different Lumascapes now. Does this mean there's even more development in different markets? What are the things that you're hearing these days as an advisor and an observer of the marketplace?
So, you know, one of the things I think people need to get comfortable with is the fact that fragmentation's here to stay. It is, you know, fragmentation happens. That could be a T-shirt. But because there's so much proliferation of new companies, it's cheap venture financing, you know, with AWS and all the technologies now, it's easy to launch a business. So let's not worry. I've now stopped calling for consolidation, just because it'll actually never happen. Mathematically, it never happens. There's been, you know, some consolidation from an M&A perspective in the space, and of late there's been some failures, both of which are good. But there's more companies every year. So point number one I say to people is just get comfortable with the fact that there's going to be a lot of companies. I think where it makes more sense to think about, though, is the scale of opportunity in some of these channels, because I think while there are many companies, very few will actually be the important companies. I mean, there's almost every Lumascape that's got between 300 and 400 companies. When I look at them, I see a dozen, maybe 20 on any particular channel of media that I actually pay attention to, because from a scale perspective, those are the ones that are probably delivering a differentiated service or product that will matter going forward.
So I remember one of the points you made when you first introduced that Lumascape way back was the amount of capital that was invested in these companies relative to market size. And I recall it being in the display world, a lot more capital was allocated to the display market than there was certainly potential for revenue or probably profits. Has that changed? And in a follow to that, what are going to be the drivers for the introduction of additional capital into the markets? Or are we going to see some pulling back of new capital?
Yeah, so it's pretty clear that the sector in general is overfunded. I think if you take the the meta or the macro numbers of what the revenue opportunity is, and then parse that down through to value relative to dollars in, it's clear that on a meta basis it's overfunded. That said, we've seen after a big sort of rather sort of draconian market moves in terms of valuation in the sector in the last 3 or 4 months with a tech correction that just kept on going, we've actually seen companies announce big financing deals. And I think what we're seeing here is a bifurcation into a winner-take-most kind of environment where, again, a select group of companies will be able to be funded and will be able to go big on the opportunity, whereas the average dog that's just fighting to get along with undifferentiated solutions is actually going to have a really hard time financing. So I think we're seeing the parsing between winners and losers.
So while we might not see consolidation, let's talk about the average dogs. Might we see, instead of consolidation, might we see expiration of those companies?
Yes. In fact, I was saying, sort of jokingly, referenced it at a conference a year ago, saying, there's 2 ways we can have consolidation. We can have M&A and we can have failure. And, in some of these sectors, if you look at the commerce Lumascape, all those companies that were doing daily deals, 3/4 of them are out of business. And that's, by the way, that's healthy. That's an efficient capital market. It's called venture capital, and with reward comes risk. And some models have not proved out. I think, quite frankly, that's healthy. And the odd part is it's really hard for some of these companies to die. So hopefully we'll see more of the differentiated, scaled companies grow and thrive, and the others will get out of the way.
So, and what do you think we'll see in the public markets? You very, very notably now have been involved in a number of offerings and filings. That wasn't something that probably most people expected when you opened up Luma as what was seen as a boutique, and I don't mean it in a bad way. I think it mean in a highly specialized way. How do you see your business as an entrepreneur?
Sure. Well, you're right. 4 years ago, when we filed for our underwriter's license, we filed for the full underwriter as opposed to just being an advisor on M&A, and we felt our sort of more objectively strategic approach to the marketplace might be able to create an opportunity for us to really help companies that were trying to tell their story to a market, to public investors who, quite frankly, were not sophisticated as it related to the complications of this space. And so we're sort of we're co-manager on several deals. We've got several more in the pipeline and a long list behind that of being able to, help these lead managers. And look, we're not taking the place of Goldman or Morgan or JP Morgan or any of these great firms, but we're there as a sort of SEAL Team 6, right? The specialized group that can come in, help them with positioning, and then hopefully over time there's a positive association. But I do think that we have been and we're going to be very selective in terms of the companies that we're going to help underwrite, because we believe that just because you can go public doesn't mean you should go public. And we've seen a little bit of adverse selection in terms of some of the early filers, and we've seen what happened in the marketplace. And so we think it's healthy that the market is discerning, so that only the better and the more scaled companies will be the ones that public investors will actually see. Because we'd like, as an industry, to have it put its best foot forward.
Yeah, I guess to your point about there being some large late-stage financings, some speculate that one of the reasons we've seen some weaknesses with some of the public companies were the small cap ad tech companies, where they were ones that had to go public. They were ones where there was a lot of pressure to go public, and maybe couldn't continue to access substantial private capital to grow the businesses larger. What do you think is going to be the outlook of the future for the small cap public companies in ad tech?
Yeah, I just think it's really, really hard to be a small cap public company, period. I mean, this industry aside, just the nature of how the buy side is developed, the size of these funds doing the investing, they consider, anything below $1 billion a micro cap. And so if you don't have that kind of liquidity where there's enough volume where firms that are doing research or trading it are paying attention to the stock, it's just really hard to get momentum. And so we've been pretty strongly in our view that you really have to have a scaled, preferably over $1 billion market cap to access the public markets.
So And final question here: is there anything that has been surprising you've learned or discovered at Cannes this year?
So we've seen a lot of activity in display because that was where a lot of the early applications of programmatic, of technology applied to media buying have seen a lot of traction. Well, obviously, the shift to mobile, everyone talks about when was the year of mobile. I think it was 2012, probably. But what we're kind of most excited about is video. And not just the growth of the nice growth of the $5.5 billion digital video industry, but really that sort of convergent space between linear television and digital video, where you're talking real dollars. There's all kinds of complications associated with it because the nature of the incumbent business is very different. But it's super exciting. Data is now available that's helping everyone from the brands to the agencies spend better, and well, you're a prime example of that. And that's it's always the 80-20 rule. And when you can get huge volume like that, and now applied where technology can be applied to a large marketplace to benefit everybody, I think that's pretty exciting. And by the way, it's going to lead to a lot of M&A. Watch, 2014 is the year of TV.